Hello there, welcome to Alternative Investing. I'm Andrew Bell. Here with me, our regular Friday co-host, David Kaufman, President of Westcourt Capital. Great to see you, David.
Great to be here.
On this show, of course, we explore investment concepts outside of the traditional realm of stocks and bonds for investors like you, who may be sitting on cash looking for alternative places to put that money, places not in the public markets, but in funds or products that fly a little more under the radar. On today's show, we are going to talk about asset-backed commercial paper. Yes, that complex financial product that caused a lot of trouble for investors a couple of years ago. But before we get into ABCP, David, there's a couple of things we should think about here when you're looking for markets and assets that are being priced inefficiently, because that's the theme of this show.
That's right. What we're really looking for is understanding how opportunistic investing works in general, and then we can get more specific. So opportunistic investing is, by its nature, tactical, meaning that you can change direction on the fly, so to speak. So the way it works is that you survey the macro environment, kind of like a plane flying over and looking around at what the landscape holds. And then you apply expertise to identify inefficient markets and or securities. And then, so once you identify the inefficiencies, then you invest. Sometimes you use leverage, and the leverage can be internal, external, i.e. you could borrow the money to do it, or you could use futures and derivatives to do that, which have sort of built-in leverage. And then the essential thing after that is once you've invested in the inefficient, mispriced security, you wait for convergence to occur. And convergence basically is that the security and the area becomes priced where it should have been priced rather than where it was. So a really good example would be, everyone's morning commute to work. That everyone is always looking for a shortcut. And so the idea would be that you look around, you find your shortcut, and once it really is a shortcut, it can only last for a while.
They call it, I believe the traffic engineers call it a rat run.
A rat run.
Anyway, go on.
So you find your shortcut, and then eventually everyone else will as well, which means that it's no longer a shortcut, and now you have to go find another shortcut. So that would be sort of how everyone would approach it. The professional routers, which would be, say, limo drivers on their way to the airport, they have better communication, better information, so they're the first people to find the shortcut. So that would be the analogy to the professional opportunistic investors who are out there looking for these investments.
So we hear about arbitrage trading, which is really mismatches. Say RIM is on NASDAQ, on Toronto. If you're quick enough, if you have the capital, you can profit on marginal differences in price. How does that fit in?
That's right. Well, opportunistic investing can take place in a very, very short period of time or over the short or medium term. And so that true arbitrage is making money in a truly risk-free way. It's very hard to find, and sometimes it's in microseconds. So you gave a perfect example. RIM trades in the NASDAQ in New York, it trades in Toronto, and even when you normalize for the foreign exchange, there may be a moment in time where you could buy and sell instantly and take a tiny profit, but if you do it in large enough volume, you can pick that nickel up, and that's an arbitrage play. But in practice, arbitrage has come really to mean the identification of mispriced securities, mispriced asset classes, and the idea would be that you wait for the convergence to happen once you make your bet. And that's why we hear about different arbitrage strategies, such as merger arbitrage, credit arbitrage, fixed income arbitrage. And today, of course, we're going to be talking about asset-backed commercial paper arbitrage, which is its own area within that set.
Obviously, ABCP, we're going to be hearing a lot about this from our guests, but a lot of people shy away from it. So essentially, some people reckon it's mispriced.
Well, when it was originally issued, it was highly rated short-term debt that was backed by collateralized by a pool of assets. That it's a bit of a longer story than we have for today, but of course it went sour during the credit crunch in 2007 and 2008, and it was restructured in 2007 in what's called the Montreal Accord, which we'll talk about, I'm sure, after the break. But the idea would be that today, the many advisors and most of the public hear ABCP and they think, no, that's toxic, that's not for me. And I would analogize it again to think of a bay where the surfers like to surf, and then there's a shark attack, and so everybody leaves. And then after a while, the people that know the bay the best and understand the sharks the best can say the sharks are gone, we can go back and we can surf alone and have a great time. And other people, notwithstanding the fact that the sharks are probably gone, would be quite reticent to go back into those waters because of the fear. They have a lack of information and they have fear, and those two things conspire against those people having the best surfing available in that period.
Well, let's take a break. Coming up on alternative investing, we're going to talk about why investors might want to put their money into restructured Canadian ABCP. Up next is Jason Marks. Now, he's CEO and Chief Investment Officer of GMP Investment Management. Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital. Today, of course, we are talking about asset-backed commercial paper. Woo! Let's talk now about some of the risks and rewards that can come with investing in the restructured version of ABCP. For that, we're joined by somebody who has been buying into this asset class, Jason Marks, CEO and CIO of GMP Investment Management. It's great to have you here.
Thanks, Andrew. Thanks, David.
Straight up, what do you do? I mean, not just with ABCP, but what do you do all day?
Right. Well, what we do all day is really three things for our investors. We preserve capital, we manage volatility, and we look for high absolute returns, given our constraints that we're trying to make sure that we don't have large drawdowns of capital and don't have big volatile and don't offer volatile returns. That's what makes alternative investing different than traditional investing, where you're subject more to the whims of the markets.
Tell us then about the play. Just remind us a bit of the history of ABCP. Right. It blew up really before the global financial crisis, although it wasn't that the assets were so bad. It was more just the liquidity dried up.
Right. So one of the things about asset-backed commercial paper is the original asset-backed commercial paper was that it was a short-term investment. That's what commercial paper is. It's typical commercial paper is 1 to 3 months in length. And what they were financing with this 1 to 3 month liability were long-term assets, long-term loans, long-term credit exposures. In order for the commercial paper to continue to function, you have to continue to be able to issue commercial paper. If the liquidity dries up in any commercial paper program, if there's no one else to step in and provide that liquidity, it will actually fall apart. And that's the risk always in any commercial paper investment.
So that's exactly what happened, leading, of course, to the restructuring in Montreal in 2007 through the Montreal Accord. So they issued this new restructured paper, and if I understand it correctly, that's what you're now placing a bet on.
Correct. And the restructured paper, now they match the term. So the term of the debt instrument that you're buying now matches the term of the assets. Mm-hmm. So you don't have the same liquidity problem that you had in the original commercial paper problem, which was exactly what they set out to do in the restructure.
And the new paper that's out there, it's essentially like a bond or a note, and it essentially matures in 2016.
That is exactly right. It's a floating rate piece bond, so it's like what would be called a floating rate note. So it pays a coupon linked to a floating rate index. So it actually, if interest rates were to rise, the interest that you earn on the bond actually rises as well.
The sharks that were in the waters in 2007, 2008 certainly took their pound of flesh. So what has the restructuring done to make the Bay a safe place to surf again? And what is it that makes it such a good bet now?
Right. So there were two main objectives of the restructuring. One was to match the term of the liability with the term of the asset. The second was to make the ability of the banks to call for margin much more restrictive, so that wouldn't happen, because that's what can cause the paper to fail. That's what happened with the short-term paper. So they made it much more transparent and restrictive, and therefore made it very unlikely that the paper would not last to its maturity date of 2016.
And still, it trades at a discount, which implies that the people that are buying now know or think they know something that everyone else doesn't know. So what is the special sauce? What do you know that other people don't know?
Right. Well, we have a tremendous amount of experience understanding structured credit. So if you understood structured credit, you would have understood when the original asset-backed commercial paper was issued what the risk was, which were the two things, the mismatched term and the non-transparent punitive margin provisions of the paper. If you understand it now, you'll realize that those have passed. But the other thing is that we understand very well what the fundamental value of the assets underlying the paper is. Those assets are worth 20% more than the paper is trading at today.
So you're getting super security.
You're getting super security, and also, that expertise is not resident in Canada to the same measure as it's resident in the United States. So a lot of the flow in this paper, a lot of the investors are coming out of the United States, which to me is a little galling in that they made the money by putting it into the Canadian investors when they were charging too much, the global investment community, and now they're buying it back at a discount and they're going to make money both ways.
So you're repatriating the opportunity.
We would like to repatriate it back to Canada. We think, at least recover some of the money that you lost along the way.
If I come to you and as a client, and I put some money into this and tie it up basically for 5 years now, what kind of annual yield am I looking at?
We anticipate that the annualized return will be at least 10% per annum. And that's an IRR kind of yield. We also anticipate, just as getting back to David's analogy about the shortcuts, that people will discover the shortcut well before the 5-year period has passed, and they will close up that discount from fair asset value to what the paper is trading at much quicker than the 5 years. So you might realize 10% per annum, but you could actually realize more of that in the early days of the investment, and that's been our experience.
You could flip it to somebody else.
Right.
And speaking of the early days of the investment, even though your asset-backed commercial paper fund is now in its infancy, your diversified fund was buying this paper over a year ago, and I think we have a chart that shows how it's already done, which is helping to prove out your thesis.
Yeah, we were very early involved in this. We probably were one of the first people to actually trade in asset-backed commercial paper. And last year alone, on the capital that we had invested in asset-backed commercial paper, we actually earned a return of 100%.
Is this showing the value on the dollar that it's been trading at, or
no? That's showing. That chart shows the return that we would have earned for every dollar that we invested in asset-backed commercial paper last year. So that dollar is now worth over $2.
You would have doubled your money as the market gets more comfortable, basically, with this?
Yeah, and as we've been able to selectively find the most undervalued pieces, because the asset-backed commercial paper isn't one instrument, it's a series of instruments, and we've been able to pick up along the way the most misunderstood assets and actually sold them. We would buy them for a very low price, and a lot of them we would on-sell them to principally American investors who would actually be paying closer to the fair value.
So that means that you picked the lowest hanging and sweetest fruit,
right?
And that bore returns for you, but it's not too late.
No. Will you be able to double your money in this year? Not likely, but you certainly will be able to capture a lot of that 15%, and we're still able to selectively determine the pieces of the tranches of the asset-backed commercial paper that are actually most mispriced. And we continue to earn returns. We launched our asset-backed commercial paper fund at the beginning of November, and to date it's already up 5%. And that's not just a mark-to-market basis. We've bought and sold out of these funds and realized some of this profit.
A lot of the viewers who hear about arbitrage strategies will remember some of the now infamous examples of arbitrage strategies blowing up, largely because of timing, largely because of the use of massive amounts of leverage. But there is certainly risk in every investment. So can you discuss a little bit what would have to happen for this to actually lose money? And conversely, how much is enough? So as you see the prices increase, when are you going to say, thanks, we've picked enough of the fruit, and now it's time to go and find another opportunity?
Right. David, well, firstly, I think there is only one event now that will put this investment at risk. And that is a catastrophic credit crisis. And when I say catastrophic credit crisis, I mean a crisis that's far more extreme than 2008.
Okay.
And a crisis that is more extreme maybe than even occurred in the Great Depression. So the underlying assets of asset-backed commercial paper are investment-grade assets. For those assets to experience losses that would be sufficient to cause impairment in the asset-backed commercial paper, you would have to experience losses that have never been achieved. And so that's the kind of scenario that you're looking at. And that's really now, in the restructured paper, the only scenario that would cause cause you to incur those losses.
Because you don't need to be rolling the sucker over.
Right. You don't have the liquidity issue and you don't have the margin issue, which are two very different issues than actual realizing losses.
So for the steamroller to reach your door, it would have had to flatten all of base rate.
For sure. I don't know that that any bank could survive a scenario where a diversified portfolio, I mean, we're talking about a portfolio of the 400 biggest companies in the world that were investment grade in 2008, actually have experienced from this point forward losses even in excess of 10%. Remember, a bank only holds 10% capital against their whole loan book. So if the biggest companies are going broke,
the banks are gone.
The banks are all gone.
So it only took us 6 months on this show to find a sure thing.
Well, you know, nothing's ever sure, but it's not sure that the banks, that your country doesn't have to come in and nationalize your banks.
So it's amazing. The banks put up these great glittering headquarters, but the bottom line is they're leveraged.
They're leveraged 10 to 1.
Yeah, to the hilt. We're almost out of time, but
sure.
What do clients say when you say, hey, I got some ABCP for you? What's their reaction?
Well, you know, it's not the easiest sell, and it really gets back to David's analogy of the shark-infested waters. It's like we're going surfing, and the waves are up, and they say, yeah, but we remember when the shark was actually there. We can't go in there. And you say, well, yeah, but it's not the same. They've actually put up walls. They've killed all the sharks. We know they're all done. So it is a bit of a tough sell, for sure.
Jason, it was great having you here. I hope you come back soon.
Thank you very much. Thanks, David. Thanks, Andrew.
Jason Marks, CEO and CIO of GMP Investment Management. Well, coming up, we asked you to email us, and you've delivered. Stick around, because now it's David's turn to answer your email questions on alternative investing. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Time now to answer some of your email questions for David. Here's number one from Greg. Is there any way to get around the accredited investor thing, such as using a waiver?
Well, Greg, that's a good question. I get this question all the time. If Greg's asking about being an accredited investor, then he probably lives in Ontario, where the rules are the stiffest with respect to who it is that it's allowed to invest in private securities. And so the bar is set very high, $1 million in investable assets or a very, very high income. The short answer is no. You can move to BC. I guess that's the really short answer. But essentially, if you live in Ontario and you're accredited, you can invest any amount of money. If you live in Ontario and you're not accredited, then you have to rely on the somewhat archaic and nonsensical $150,000 exemption, which means anyone in Canada that invests $150,000 into a single investment is considered to be de facto sophisticated, and therefore they don't have to be accredited. The problem with that is that brings up suitability issues, because there's no other test for that. So someone could have $400,000 of net worth and be convinced to put $150,000 into one investment because therefore they don't have to be accredited, and they're not accredited. And suddenly a dealer would have to ask serious questions about how suitable that investment is for that person's time horizons, investment capabilities, risk tolerance, that sort of thing. And for that, there is a waiver. So that if a dealer says to someone, this is not suitable for you, it is possible for that person, notwithstanding the comment, to say, I'm going to waive the suitability requirement, and I'm going to invest anyway. So in the West, it's still somewhat the Wild West from the point of view of securities regulation, where if an investment product is sold through a what's called a 45103 offering memorandum, basically an offering memorandum that is kind of like prospectus light, that then they can use that as an exemption to invest much smaller amounts of capital. That's not available in Ontario, and if and when we head towards a national regulator, we'll probably see the Ontario rules adopted across the country rather than vice versa, and so it's going to be more difficult, not less difficult, for people like Greg to be able to make those investments.
Here's an email from Fred in Vancouver. I enjoyed your show on fund of funds, but I keep coming back to the issue of fees. How can I rationalize paying fees to both the manager of the fund of funds and to the managers of the funds inside the fund of funds?
Yeah, we brought that up, and that's certainly, in any discussion of fund of funds, is always going to be the number one question. Fees on top of fees is very expensive.
If you end up paying 3%, I mean, that's a pretty heavy load.
It can be a very heavy load, and there's no doubt that it's a potential disadvantage of using a fund of funds. But what you're doing in a fund of funds is you're hiring professional management to source the best managers, to diversify among different asset classes, to lower volatility, potentially potentially increase returns. The whole point of the whole exercise is to increase the risk-adjusted returns, which include the concept of the volatility that you might have within the portfolio. And so in the end, it comes down to a question of net performance. So, let me say this. If you knew today that a fund of funds would return you 12% next year and another hedge fund that had lower fees with the same type of risk associated with it would return 8%, it wouldn't matter what the fees were if you knew that in advance. Now, of course, we don't know that in advance. And so it's important to think about fees when you're doing your calculus of the likelihood of that happening, of having the return that you're expecting. But they shouldn't up front mean that you would say no right off the bat, because it might mean that you're missing out on the kind of diversification that the fund of funds exists for in the first place.
Well, let's talk about next week's show. What have you got coming up?
Next week we have peer-to-peer lending, which is one of probably the second oldest profession in the world is lending money. Long before banks were involved in intermediating loans, you had people lending to other people. Now, with Web 2.0, which is actively having one person funding another person somewhere in cyberspace, what happens is that people can say, I need to borrow an amount of money, and a bunch of lenders across the globe can bid on that person's loan. And it's like a reverse auction, so that the lowest interest rate that will be charged for that loan wins. So we'll be talking to Michael Garrity from Community Lend, which is one of the leaders in Canada in this space. It's been quite popular in the UK and in the US. And what it results in is the disintermediation of the lending process, so that you don't have the big fees taken out by the middleman, being, say, a bank, where you'll have a tiny little fee taken out by the person who's helping you process the trade. It's a fascinating area that's growing quickly, especially as the web, of course, has greater and greater concentration across the country.
I guess the problem is, how do you check out the person you're lending money to?
That's one of the things we'll talk to Michael about, because that's one of the roles that the intermediary does play, is the credit adjudication. So they're going to, you're not going to say that this person's totally anonymous. You may not know their name, but you'll know their credit history, and you'll know the kind of assets that they may or may not be willing to put up as security for their loan, and then it can get much more complicated than that. They'll also help you put the loan documents together, because that's one of the things that not everyone has any experience in, knowing what terms there should be in a loan. And in the end, of course, the devil is in the details. And so having a properly structured loan agreement is the recipe for success in the event of a potential default.
Fascinating stuff. Yeah, P2P. I mean, that's a market you hear about, P2P lending, but we haven't had much about it on BNN. So
you're now
breaking new ground. That's what this show does.
Every week.
Thanks a lot, David.
Thank you.
That's all the time we have for on today's edition of Alternative Investing. We will be back next Friday at 11:30 Eastern, 8:30 Pacific with another show. Now, we didn't have time to answer all of your emails this week, but we'll have plenty of time for the mailbag next week. Remember, get in touch with us at alternativeinvesting@bnn.ca. Thanks very much for watching. Have a great day in the markets and a great weekend, everybody.